Good afternoon, everyone, and welcome to Prestige Wealth Management Group's first quarter of 2022 economic and financial markets update. On today's call, you're going to hear from Prestige Wealth Management Group's founder and CEO, Roy Williams, Senior Portfolio Manager, Paul Esposito, and Wealth Advisor, John D'Angelo. Just some quick housekeeping before we get started. Today's webcast is being recorded, so you will receive an email with a replay of today's webcast. And if you do have any questions, we can't take any live questions during the webcast, but if you send an email into pwm@prestigewmg.com, we will be sure to get to any questions that you have. On the agenda today, we're going to first talk about the inflation pressures that everyone is experiencing. Then we're going to move to the Fed and rising rates, the war's impact on global economies, equity and fixed income market overview, importance of maintaining a long-term view, and then finally with some Q&A. So I'm going to start off by kicking it over to Paul Esposito to discuss the long-term views of the U.S. inflation.
Hey, Michael, thank you very much. First quarter of the year has certainly, put the markets to, both the stock and bond markets, to quite a test. And I must say, despite, the detraction that we've seen in both asset classes, U.S. market at least has still been able to establish, from what I like to say, a hint of optimism, and on a relative basis has been very resilient when compared to the rest of the globe. But obviously the front and center story for this year has been inflation, the Fed's response, their tone to raise rates and really combat inflation kicked into high gear in December of this past year. And of course, with most recent Fed policy meetings, we saw our first hike in March. But those issues have further been exacerbated. Obviously, we've also seen the Fed wanting to really push more so for unwinding its balance sheet. And then, of course, the geopolitical tensions, the tragedy in Russia and Ukraine has certainly made their job of combating inflation even, more difficult. But again, given, I think the environment, given the conditions, actually quite surprised that the markets have digested a lot in such a short period of time. But if we look at just the uptick in inflation on a year-over-year basis, so this is closing March, we've experienced 8.5% of CPI inflation here in the U.S. That's quite a number. It's a number not seen in the last 40 years. And the Fed is, certainly concerned about this. And, one would usually ask, well, why? Obviously, price stability is one of the Fed's key mandates. And if we look at how inflation impacts a lot of the numbers, look at the chart below, you can see inflation ranges, right? Below 1%, 1 to 4, 4 to 9. We've been running in the 4 to 9% for the better part of a year. And that has certainly translated into lower productivity, lower growth, lower total return for the S&P. So the Fed is really compelled to correct this and get inflation under control to its longer-term target, that target rate being 2.5%. And, if we can get back to that 2.5% level, that, 1 to 4 range, the economy, the markets can now start enjoying better productivity, better GDP potential, and most importantly, better returns, and not just for stocks, but also for bonds, which have been a lot more inflation sensitive this quarter than the rest of the equity market. But the most recent surge that we've seen, there's a lot of market pundits that like to use the great inflation, the 1972 to early 80s inflationary cycle as a prologue. Some similarities, there are some, tighter commodities markets, albeit not an oil embargo. And the Fed did have, at least in the earlier days, the early 70s, there was more accommodative policy, there are some stark differences. First and foremost, Nixon took off the gold standard, devalued the dollar. That created a hyperinflationary environment. We're seeing quite the contrary here today, with the Fed wanting to make rates go higher, unwind their balance sheet. That's causing the dollar to strengthen. If you look at commodity supplies, although the tensions abroad have certainly, added an additional wrench into supply-demand dynamics, we, as a country, and really even globally, are not as dependent, on various oil complex producers, especially here in the U.S. Up until recent, we were a net exporter of natural gas as well as oil. Probably enjoyed some of the greatest energy independence in our time. So again, quite different. This go around, if you really look at the primary causes of inflation, a lot of it stems from the supply chain issues that were created by the pandemic. You've had factories throttled, and then of course initially there was a significant amount of demand-driven inflation by monetary stimulus. You had PPP loans, all of the 3 different tranches of stimulus and an accommodative Fed led to a lot of initial consumption. And we'll see in a little bit, just exactly where we're at in terms of supply chains. But that's primarily been the reason why the Fed in 21 was waiting to act, right? They were of the assumption that, and they threw around the term transitory, overused that term until transitory became a trend of somewhat permanence. So because they were in essence figuring that supply chain dynamics would even themselves out and help with that inflationary pressure, which they still expect in the tail end of this year. It's just that some of the unfortunate events abroad have caused those time frames to be drawn out a little bit more. But inflation overall, has been widespread, and I'm going to hand it over to Roy. He'll talk a little bit more about the components of inflation. Roy?
When you look at inflation, excuse my voice, we all have felt the energy increase of 60 to 70% in the past year and a half. In terms of new and used vehicles, there's a shortage of vehicles. When we look at going to buy a car dealerships are adding, depends upon the kind of car you're buying, $5,000 to $20,000 to the sticker price. Forget getting a discount. Food and home costs, when we look at rentals are through the roof. Food costs, I shop at Costco, and, ribs that were less than $20 for a pack of 3 now is approaching $50. So, then you have restaurants, hotels. As demand has picked up again, so is demand for travel and transportation. So we're seeing, even though airlines lock in their rates in terms of fuel rates for a period of a couple of years into the future, there's still the prices have moved up significantly. So when we look at this overall, we're all feeling it. There's nobody who's not feeling it, because it's not just gasoline. It's throughout. Shipping containers have gone up tenfold. So now your cost of goods that you're buying, I don't care if you're going to Walgreens to pick up a couple things or Costco, you're paying more for these items. So again, the hope is that hopefully they come to some resolution in the war that's happening in the Ukraine with Russia, and at that point, I think you'll see energy prices subside, which hopefully will impact the rest of the supply chain as that happens. We're still going to feel it for the next quarter in the supply chain because of what's happening with the getting raw materials, because some of the things happening in the world right now. China has shut down a couple of major cities. I read an article yesterday, poor people have just been locked up into their house. They can't get out, of their home. So it's going to be, a challenge, I think until probably hopefully it subsides in as we get through the next quarter, we see things subside. Paul, why don't you talk about inventories?
Sure, Roy. Obviously highlighting, the issues that still persist in the supply chain. We've got, really the trend of both inventories as well as deliveries, both prior and after the pandemic. So the light blue color is inventory levels. The dark blue are deliveries. Prior, to the pandemic, the index resided for both of them about 50, so there was a nice balance. But what transpired during the pandemic is, a couple of things, that we said earlier. One is you initially saw a stimulus come into the market at a time where you had numerous factories shutting down, further distorting supply chains, causing inventories to dwindle. And at the same time, that stimulus money had to go somewhere. A lot of people, put an addition on their house, went out and bought appliances, bought cars. And as a result, you saw supplier deliveries spike. At the same time, you saw those inventory levels diminish. And that trend continued into 21. I know the auto complex, where you mentioned earlier, was probably the hardest hit in terms of, next to energy inflation in 21. Continues to be the case. I know there was some, out of CarMax's earnings guidance, they claim that there's, at this point, there is some price stagnation in their used car lineup. So that maybe is going to portend to some inventory pickup there. But what the Fed has done and what the high level of inflation has done has been somewhat corrective to at least the deliveries aspect of things, which that as of late has started to come down substantially. The inventory levels are still over 30% below pre-pandemic levels, and more than likely, we would probably have seen them a lot higher toward the quarter close, but of course, the conflict over in Ukraine sort of again set supply chains into a standstill, at least in an indirect fashion. So as those two converge, we will start to see normalization. When we start to see normalization in the inventory numbers, which again the Fed is projecting possibly by Q4 of this year, we'll start to see those balances turning back. Anecdotally, I was out appliance shopping over the weekend and for washer dryers. So apparently, no problem at Lowe's and Home Depot. They had 1,000 in inventory. Now, the only areas where it's still a bit problematic with the semiconductors is with, for some reason, refrigerators and dishwashers. But at least you're starting to see some of that global supply chain come back, into focus and balance things out. I know, this time last year going through a similar exercise, good luck. It was, having to go through 5 or 6 different retailers before you could find something that hopefully would be delivered in the next 3 months. So that being said, John, wanted to sort of give the audience the lay of the land for what the Fed's policy has in store for this year.
Sure, Paul. As you mentioned earlier in your conversation, the Federal Reserve looked at inflation as a transitory event early on, which led to I would call an outstanding return from the standpoint of stock market performance. a year ago. You know, since that point in time, I think the supply chain disruptions have, you know, exacerbated since I'd say probably summer months. And the Fed, you know, in December, you know, had to really shift gears and start speaking down, you know, being accommodative and start looking to be more restricted. So they started that in December. You know, usually the Fed will speak before they act. I think when we think of the first quarter's market performance, you know, a lot of what we've seen from the standpoint of the volatility and some of the softness in asset prices came from this anticipation of the Fed starting to raise interest rates. And as you can see in the chart, we've got the first hike that's in. The expectations are we're going to see a total of maybe 6 hikes through the end of the year. Recently, Chairman Powell's come out and talked about potentially a 50 basis point hike in order to get in front of what I would say is an unexpected turn of events for the Fed with the conflict in Ukraine. So the conflict in Ukraine is really just kind of, supersized, you know, some of these supply chain problems and some of these inflation pressures. Now, when we think about this, though, you know, the light at the end of the tunnel is that when we get toward the second half of the year and we start looking at, you know, fourth quarter of this year and into next year, the Fed should be through a lot of these rate hikes. Perhaps we'll have seen, I'll call it an interest rate high somewhere, which has already been shown in mortgage rates. Right, so we've seen mortgage rates come up, and as mortgage rates come up, that should cool things like housing a bit, and also help to quell a little bit of the inflation pressures that we've seen over, you know, the last year and change. When we think of the Fed and we think of the tools in their toolbox, interest rates and the federal funds rate is just one tool. One of the other tools in the Fed toolbox is how to handle the balance sheet. And Roy, why don't we talk a little bit about what the Fed's been doing when it comes to the balance sheet?
Paul. Certainly.
Paul, I'm sorry, Paul.
No worries, Don. So when we look at, obviously, you know, the policy tools at hand for the Fed, you've got the Fed funds rate, right, as the more direct action of raising and lowering interest rates to combat inflation or to help stimulate growth. The balance sheet expansion has been instrumental, right, and this has been really a policy tool invented during other central banks have had it for quite some time, if we reference Japan, but it's really been a policy tool that's been embraced by the Fed since the Great Recession. And essentially what it does is it further it has the impact of an interest rate hike or decline equivalency. Every $300 billion worth of Treasury and mortgage-backed bonds that the Fed purchased in 2000 all the way till 2022 is the equivalency of a 25 basis point decline in rates. So if you really think about it, there's been the Fed lowered rates from about 2% all the way down to 0 as part, of its monetary policy to combat the pandemic. Well, the other side of that, and probably the more impactful, has been the expansion of the balance sheet, which, if we really think about it, $9 trillion divided by the 300 billion, and if we equate that to 25 basis points, that would round out to about a 4% further decline in interest rates or easier monetary policy. So it's been substantial, and that's one of the reasons why asset prices have done so well since 2020. And then obviously now the Fed really wants to get ahead of inflation because it feels it's a bit behind. They did posture to start letting some of their balance sheet mature and roll off in the months ahead. Previously, what they were doing was with any maturities, they were just reinvesting it back into the bond market, different parts of the curve, intermediate, longer term, keeping rates lower. The objective now at the next meeting is to let about $90 billion roll off. So between now and the end of the year, the Fed, could potentially be inducing an additional 50 to 75 basis points of additional tightening to interest rates already. In particular, they did want to target the mortgage-backed securities so that mortgage interest rates could moderate higher. They obviously were very concerned about making an error of the past and letting mortgage interest rates stay too low for too long, creating a potential asset bubble. But historically, when I look at what the Fed intends to do and what actually transpires, it's usually night and day. I don't know if it's going to be the same case, this go around with their balance sheet. But when you go back to 2013, we had a very similar interest rate shock to the bond market, right? It was called the taper tantrum, where the Fed said, hey, we're no longer going to buy any more bonds. We're going to start unwinding them on the balance sheet. Hey, it worked until, a few months later. And then the Fed re-engaged its asset purchase program. So not to say that, I'm taking with a grain of salt this go around the Fed's intentions, because there certainly is a lot more inflation in the market than we had in, the 2010 to 2018 environment. But the forecast in their balance sheet unwind is debatable. And there's been, the word rhetoric, right? We toss that around a lot. The Fed has numerous policy tools, right? Two primary. It's the Fed funds rate and the balance sheet. The third, and as I've always said, is the Fed's ability to jawbone the markets higher or lower to help, combat inflation or to help stimulate growth. So if conditions, are going to be problematic for the Fed to continue on a route of the hawkish pace of tightening, it wouldn't surprise me. And this is where you could get, a very nice dovish surprise to the markets where, supply chains start to normalize in the second half of the year. Maybe the conflict abroad starts to, have, some inkling of a resolution. And then all of a sudden, the inflation story is not as prominent, leading the Fed to, maybe leave this policy tool on hold for the time being. But nonetheless, it is another driving force. It's something that, we're very cognizant of, and what impact it's had not only on the equity but the fixed income markets. So that being said, Roy, I think, with just how challenging of an environment that fixed income has been, for investors, over the past year, in particular just this quarter alone, given, the surge in inflation. Why don't you discuss, the silver lining and where we're at in the fixed income markets between now and the rest of the year?
Yeah, the good news is that we're in the U.S. markets. We're not overseas. We're still, have still relatively very low yields, overseas, compared to the U.S. The positive side of this is that the yield of the bond portfolio in terms of interest rate yield is now, a little north of 3.5%, which as we go forward will bode well from an income standpoint. Bonds weren't giving much income the past few years, and now we're going to be in position where we'll get a decent amount of income from bond yields, and investors will get compensated for the risk they take in bonds. So when we look at this, interest rates going up, housing, I just want to say our banking system is in excellent shape. A lot of times as we head into the dynamics of the markets that we have, our banking system gets in trouble. Right now, our banking system is on very, very solid footing after the COVID started in February, March of 2020. The housing market and defaults have been very low. You have very little inventory. So, the banking system should stay on solid footing as we go forward, which is, contrary to the concern with COVID and contrary to what happened during the financial crisis. So with that, Paul, why don't you talk about in terms of past rate hike, past cycles?
Absolutely. Roy, so if we look at the last 6 rate hike cycles, the key takeaway here is, on average, the Fed's hiked about, 9 times over an 18-month span. Prior cycle, much longer, right, 36 months, and right around the same overall average for the collective, past 6 cycles. And a lot of that has to do with the disinflationary environment that we were in from 15 to 18, right? The Fed's problem was we didn't have enough inflation. Well, this time, I think, the Fed got maybe a little more than a bargain for. A question that's come up a lot during meetings is, if we look at this rate hike cycle, we look at the inflationary environment that we're in, how many hikes, over what time period do you expect this rate hike cycle to last? And, if I were to look at the late 80s, or should I say early 80s hike that we had, right, to combat the great inflation, I don't think it's going to be, as drastic, in terms of the levels of increases. Obviously, we've seen numbers, right? Fed's postured to 50 basis points, right, as a larger uptick to the standard 25. I don't think you're going to see, any 100 basis point, plus hikes, just because the inflationary environment back then, again, was more hyper/stagflationary environment compared to this go around. However, the inflation is still there, so I do think we're probably going to see, a much shorter cycle. A lot of that has to do with the baseline. The last, rate hike cycle, the Fed funds rate ended at 200 basis points. We're, again, coming off of the zero bound and then heading back, along with a balance sheet unwind. So, the Fed is postured at about 6 this year, could be, a few more into next year. When looking at past rate hike cycles, I'd say the 99 to 2000 probably is best in terms of prologue, especially from an asset class standpoint. You had a shift in dynamics from growth-oriented stocks to value-oriented stocks after the tech bubble. I'm not insinuating that there is a tech bubble. Tech companies are far more capitalized than they were, and far more profitable than in the 99-2000 era. But if you look at the rate of inflation, if you look at where the Fed was during that time, I think that probably is going to be a more reasonable, prologue. But in looking at, equity returns, although in the short run, equity returns are always going to be challenged in a rising interest rate environment in the short run. Once equity prices start to bake in the trajectory of interest rates and start to normalize and start to discount all of those future cash flows at a higher interest rate, the market usually tends to digest that and usually tends to power forward. We've been through this before. I mean, we saw it in 2015 and 2016 when Janet Yellen was bringing us off the zero bound. Again, different conditions, but same stance, raising rates, more restrictive monetary policy. the markets were, not only disrupted by that, but had a whole other slew of issues, right? We had Brexit and Grexit and all of the other global, geopolitical problems that are probably very similar today. But, in looking at past rate hike cycles, and especially ones that mirror the dynamics today more closely, there is a very good potential for the equity markets to recover and, endure, nominal, to higher single digit positive total returns. So, I don't want to, spout that it's, everything right now is rainbows and unicorns. That's, certainly not the case, but at the same time, it's always darkest before the dawn. And I think investors need to be mindful of enduring the environment that's toughest so that, on the other side, they can, enjoy the potential returns going forward.
And just to piggyback on that, and it's something that Dr. Siegel points out quite a bit, and something that we believe in, is that you got to remember that equities are real living companies that have the ability to adjust to different environments that they're in, whether it be inflation or rising interest rates. So he always says that equities are real assets, and we believe the same. So just having that flexibility could add to, obviously, some of the potential upside through the end of this current cycle. So, welcome.
Well, obviously the monkey wrench that's been thrown into the global economy has been the conflict with Russia and Ukraine, and obviously all the impending sanctions, obviously the sanctions that the U.S. has issued from a financial system standpoint, as well as import-export. So we thought it would just be important to really highlight, the overall dependence of the globe on Russian exports. So if we look at Russia as a country, a very commodities-heavy, export-oriented country, right? If you look at crude oil, refined petroleum, and commodities accounts for over half of what Russia sends to the rest of the world. That aside from, other metals as well as agricultural products. And if you look at where those exports go, the good news is, from, a U.S.-centric standpoint, we really don't get much from Russia. Now, directly, that's great from a supply chain standpoint. Indirectly, we obviously understand that we're in a global economy, and obviously, any strain in a supply chain abroad can certainly have a trickle-down effect into our own economy. But if you look at the direct relationship with Europe, right, Netherlands, Germany, Italy, France, right, all those, very dependent countries on Russian exports, that does put their economies in a more challenging position, especially if they really do embrace wholeheartedly sanctions, that have been discussed over the course of the last couple of weeks. China, the rest of Asia, I would say that, South Korea and Japan will probably embrace those similar European sanctions. China, on the other hand, has been, rather silent when it's come to that. But nonetheless, I think that, the big takeaway from here is, the fact that the U.S. is not as dependent on Russia. And the good news is, as a firm, we are U.S.-centric in both our stock and bond portfolios, although, we have been subject to volatility, nowhere near the amount of volatility in the European and, the Asian markets. This really could present a severe economic hardship for Europe in particular in the quarters ahead. Especially if you look at the level of dependence on energy products. So Russia exports about half of its crude to Europe, almost 75% of its nat gas to Europe as well, most of that going through Nord Stream 1 and the soon-to-be commissioned, previously soon-to-be commissioned Nord Stream 2. Now, Russia only accounts for about 10% of total petroleum supply, which is why, initially with the onset of this conflict, you saw oil markets skyrocket, you saw nat gas markets, follow the same pattern, and of course, all of the other, agricultural and metals commodities that Russia exports go up substantially. However, you will undoubtedly start to see those, that level of supply be produced elsewhere. As I said earlier, the U.S. used to be the swing producer. I think we kind of traded cards with the Saudis again. But the Saudis, as well as the U.S., do have the capability to come online and start increasing output, especially in the way of natural gas. We've already started to see that out of the Marcellus region in the U.S. with LNG barges going across the Atlantic into Europe.
Paul, also, if we do see a treaty in Ukraine, that could portend to a relief rally based on these numbers.
Oh, no, without a doubt. Well, let's just say that doesn't transpire, right? I think you will start to see supplies balance out. Obviously, what's just recently occurred with the lockdowns in China, that's tamped down on demand somewhat. But yes, obviously, a resolution or moving toward a resolution would certainly bring those prices back into check. The same, when it comes to, the import side of things. So, Germany, with the collective, greater Europe has a substantial amount to lose with, Russia as being a primary trading partner. You've got, almost, 50% of imports are going to go to Russia, which is one of the reasons why the sanctions, issued by the U.S., were certainly not as effective or won't be as effective as sanctions issued directly by Europe. Nobody wins here. I think we all know that. I mean, the people of Russia are going to be, be brought to a level of economic hardship, that is going to be very trying. At the same time, the export market for Europe is certainly going to hurt at a time where inflation is at an all-time high. So, that trade relationship and dependence that Europe has, mostly on the energy side of things. And I know at the onset of this whole conflict, you saw electric rates, tolling rates in Germany go up 400 to 500%. So that coupled with lower export going to Europe is, going to be very problematic for that economy. So, John, since we are, again, a U.S.-centric firm, and of course valuations have come in since the start of the year, why don't you just give us, a 30,000-foot view of where we're at on the valuation spectrum?
Sure. Let's talk a little bit about that. The chart, interestingly, this is one of our favorite charts. You can see that as we got toward the end of the quarter, valuations were pretty high versus the historical average. We've started to see that come in. This really is along the lines of some of these rotational trades that we've seen since the pandemic started. So early in the pandemic, we had those pandemic stocks, mostly technology companies that were, you call them the stay-at-home companies, very high valuation companies, but they were certainly the darlings early on. And we've started to see over the past year or so this rotational trade, which started with the cyclical companies, more value-oriented companies that had much lower PE ratios, and we saw Now I'd call it a correction. We're in a correction territory for the technology sector, and certainly any company that had high multiples, high growth without much in the way of cash flow got certainly crucified. I would say from fourth quarter through the beginning of this year. And now we've seen this rotation move also into some of the more defensive sectors like consumer staples. So, I would say that perhaps valuations could come in a bit more, but this is also what I would call a positive outlook to a second half story, where we can see asset prices recover and rally into the end of the year, perhaps maybe into early next year. So let's talk a little bit about investor sentiment, Roy.
Yeah, when we look at investor sentiment, when we're near the lows is the best time to be bullish. When we're near the highs, it's best to be cautious. At this point in time, we're seeing, investor sentiment, not quite where it was in during the period of time when COVID started, but we're not far off that level. The sentiment from Ned Davis is shown here. Again, this is why you need to stay invested. As Paul and John pointed out, I mean, if oil prices flip, you'll see a huge rally in a very quick fashion. There's a chart, which we don't have today, which shows if you miss some of the best days, it's really investing and being in the market and being there for the good days also. It's not just avoiding, it's very difficult to avoid the tough markets like we've experienced. And, when I look at the numbers, a different chart, something I was looking at earlier today, U.S. market performance during rate hikes, on average, annualized since 54, it's about 5.4%. Again, we're not guaranteeing that's going to happen this time, but on average, that's what's happened with the 12 rate cycles going back to 1954. So, I think importance here is to have a diversified portfolio. And again, this is very challenging, the time we have right now, but we need to hang in there so we're there. As John pointed out, this could be a end of a year type of rally. We need to be in the markets to participate in that rally. So with that, I'm going to turn over, Mike. I want to thank everybody for the time today. And again, I apologize for my voice today.
That's all right. Well, thank you everyone for joining us this afternoon. Again, just as a reminder, you guys be on the lookout for an email that will have the replay of today's webcast. And if you did have any questions that we didn't cover in today's presentation, please send them in at pwm@prestigewmg.com. And with that, we want to thank everyone for joining, and we will see you next time.